and welcome to HAVE.crypto's YouTube channel, where you can find and learn everything about crypto markets and trading. In today's lesson, we will talk about one very important topic for every trader: candlestick pattern and formations. So, take a comfortable seat and let's get started. A candlestick is a way of displaying information about an asset's price movement. Candlestick charts are one of the most popular components of technical analysis, enabling traders to interpret price information quickly and from just a few price bars. Each candlestick has three basic features: the body, which represents the open to close range; the wick or shadow, that indicates the intraday high and low; the color, which reveals the direction of market movement. A green body indicates a price increase, while a red body shows a price decrease. Bullish candlestick formations. Bullish patterns may form after a market downtrend and signal a reversal of price movement. They are an indicator for traders to consider opening a long position to profit from a possible upward trajectory. Hammer. The hammer candlestick pattern is characterized by a short body with a long lower wick and is found at the bottom of a downward trend. A hammer shows that although there were selling pressures during the day, ultimately a strong buying pressure drove the price back up. The color of the body can vary, but green hammers indicate a stronger bull market more than red hammers. Inverse hammer. A similarly bullish pattern is the inverted hammer, the only difference being that the upper wick is long while the lower wick is short. It indicates buying pressure followed by selling pressure that was not strong enough to drive the market price down. Bullish engulfing. The bullish engulfing pattern consists of two candlesticks. The first candle is a short red body that is completely engulfed by a larger green candle. Though the second day opens lower than the first, the bullish market pushes the price up, culminating in an obvious win for buyers. Piercing line. The piercing line is also a two-stick pattern, made up of a long red candle followed by a long green candle. There is usually a significant gap down between the first candlestick's closing price and the green candlestick's opening. It indicates a strong buying pressure as the price is pushed up to or above the mid-price of the previous day. Morning star. The morning star candlestick pattern is considered a sign of hope in a bleak market downtrend. It is a three-stick pattern, one short-bodied candle between a long red and a long green. Traditionally, the star will have no overlap with the longer bodies, as the market gaps both on open and close. It signals that the selling pressure of the first day is subsiding and a bull market is on the horizon. Three white soldiers. The three white soldiers pattern occurs over 3 days. It consists of consecutive long green candles with small wicks, which open and close progressively higher than the previous day. It is a very strong bullish signal that occurs after a downtrend and shows a steady advance of buying pressure. Before moving to the bearish formations, make sure to like the video, subscribe to our channel, and click on the notification bell. It's free. Bearish candlestick formations. Bearish candlestick patterns usually form after an uptrend and signal a point of resistance. Heavy pessimism about the market price often causes traders to close their long positions and open a short position to take advantage of the falling price. Hanging man. The hanging man is the bearish equivalent of a hammer. It has the same shape but forms at the end of an uptrend. It indicates that there was a significant sell-off during the day, but that buyers were able to push the price up again. The large sell-off is often seen as an indication that the bulls are losing control of the market. Shooting star. The shooting star is the same shape as the inverted hammer, but is formed in an uptrend. It has a small lower body and a long upper wick. Usually, the market will gap slightly higher on opening and rally to an intraday high before closing at a price just above the open, like a star falling to the ground. Bearish engulfing. A bearish engulfing pattern occurs at the end of an uptrend. The first candle has a small green body that is engulfed by a subsequent long red candle. It signifies a peak or slowdown of price movement and is a sign of an impending market downturn. The lower the second candle goes, the more significant the trend is likely to be. Evening Star. The evening star is a 3-candlestick pattern that is the equivalent of the bullish morning star. It is formed of a short candle sandwiched between a long green candle and a large red candlestick. It indicates the reversal of an uptrend. 3 Black Crows. The 3 Black Crows candlestick pattern comprises of 3 consecutive long red candles with short or non-existent wicks. Each session opens at a similar price to the previous day, but selling pressures push the price lower and lower with each close. Traders interpret this pattern as the start of a bearish downturn. Dark Cloud Cover. The dark cloud cover candlestick pattern indicates a bearish reversal, a black cloud over the previous day's optimism. It comprises 2 candlesticks, a red candlestick, which opens above the previous green body, and closes below its midpoint. It signals that the bears have taken over the session, sharply pushing the price lower. If the wicks of the candles are short, it suggests that the downtrend was extremely decisive. Thank you for watching our video. Next time, we will continue with part 2 of this video. Also, don't forget to check out HAVE.crypto.io and try our trading indicator. Subscribe and don't miss this opportunity.